Good afternoon. Thank you for joining us and welcome to our webinar, One Global Group Presents with Barratt London. I'd like to introduce you to my esteemed panel. Firstly, I'm the moderator for today's episode. My name's Adam Sweesey. I am Head of Project Consultancy for One Global Group. And with me today we have our esteemed guest, Stuart Leslie, who is Head of International for Barratt London, alongside Richard Lowe, who's Director at One Global Expat, and lastly but not least, our founder and CEO, James Puddle.
Hi there.
Without further ado, I'm going to pass you over to James, who's going to give you a bit of an overview on the One Global Group.
Hi everyone, welcome to our shop house here in Singapore. I'm James Puddle and I'm the CEO of One Global Group. And it's great to have everyone here today. Thanks for joining us. Brilliant to have Stuart Leslie, who's flown over especially from London and landed this morning. So yeah, great to have everyone here, and hopefully you find today useful. Just a little bit of an overview. So One Global Group was founded about 6 years ago. We're a boutique residential agency business, and we specialise in overseas project marketing. We're over 50 staff across 6 offices. We've got our head office here in Singapore, office in Hong Kong, Malaysia, Dubai, South Africa, and the UK as well. As I said, we primarily focus on residential, but we've also got a commercial team here in Singapore. We focus on the sales and leasing side of things as well. So brilliant for you to all be here today. And we've also got a private office team as well. Just to give you a bit of context, as I said, so this is where our office network is here. Our biggest office is here with about 35 staff. I'm now going to hand you over to Richard Lowe. Richard's going to give you some insights into the UK and the London market. So Richard, I'll pass it over to you.
Lovely. Thanks, James. So good afternoon, and again, great to have you on air today at our live event. I'm going to be just spending 10-15 minutes going over some of the trends in the London property market. It's obviously been quite a tumultuous time in recent weeks. But let's just start with a little bit of a refresher of what's kind of happened and some of the changes that people are looking for when deciding on investing or buying a property for their personal use from pre-COVID to now what we really see as post-COVID times. So you'll see from the bar chart here, right at the top, one of the most important criteria when selecting a property is the energy efficiency. Other things that we've seen through COVID is the race for space by having additional balcony space, maybe communal gardens, or access to open parkland near where your property is. Whereas pre-COVID, what we were seeing is that very often some of the key criteria when selecting a property was what is the access to work in the office? What is the proximity to transportation? So we've really seen quite a shift in what people are looking for during these times, and again, quite strong data showing what people are looking for. So as I mentioned, I'm going to be giving some overview to the London property market and why London. So here we've got various images, but when we look at London, it is one of the dynamic cities of the world. It's got a very robust and extremely diverse economy. It's not dependent on one specific industry. Interest rates, if we look at this time last year, were at an all-time low, but we have seen interest rates starting to rise quite rapidly, and we're going to go into a bit more detail on that. When we look at the supply-demand of real estate in the UK, London is probably as bad as anywhere in terms of the overall supply-demand deficit, and we'll go into more detail there. London is a major student population. It's estimated that there's roughly 500,000 students in London. Why is that important to real estate? Well, many students wish to rent a property or a room, and obviously these are potential tenants for investors. They also, once they've graduated, become a talent pool to add to the job market and the economy, and with a higher disposable income, maybe either renting or buying their own property. Down at the bottom left, the icon of Crossrail, or what's now called the Elizabeth line, has now become operational, which is great to see. And that's having an impact on the speed at which people can move across London, and of course the real estate in and around that area as well. The London population continues to grow, which is putting additional strains on the market. So we're going to cover in a bit more detail some of these trends and how it impacts a real estate decision. Now, PwC each year do a market update of tier 1 cities across Europe. And they use a variety of criteria to really forecast where they see the strongest real estate cities in terms of investing in a property and also for developers developing property. And for 2022, we see that London has come on top. It's pipped Berlin for the first time in quite a few years. Berlin was up there for many years in a row. So it's great to see that a third-party testimony from an organization like PwC is rating London as the best city, tier 1 city, I should say, in the UK at the moment. Sorry, in Europe at the moment. Now, something that's been swinging around a lot in recent days and weeks is the exchange rate. Now, for those of you who don't know me, I've lived in Singapore for now 27 years. When I first arrived in July 1995, the exchange rate between the Sing dollar and the pound sterling was 2.6 Singapore dollars to £1. I remember selling a property in 2007 in the UK when the exchange rate was 3.15 Singapore dollars to the pound. And today when I was checking, it's at 1.58. So it's at almost a 50% reduction compared with 2007. We can see on the chart here as well that around about 2016, it was at 2.2 and then dropped by about 20% soon after the Brexit referendum, has hovered around about the sort of 1.7, 1.8 mark. But then in recent weeks, we've seen it drop again to its lowest point at 1.5 a couple of weeks ago, just after the mini budget. I think really the take-home story here is not rocket science, that if you are living in Singapore, you're earning Sing dollars, the buying power of the Sing dollar is exceptionally strong, and obviously buying into an asset class in the UK such as real estate is very attractive. There are, for those viewers coming from other countries as well, places where we have offices like Hong Kong, again, very, very attractive exchange rate opportunities. Now, one of the key things that's going to continue to drive both capital growth as well as rental growth is supply demand. And really the two macro things that dictate supply and demand, one is population growth and the other is what is the supply or possibly undersupply of a property market. Here we can see that London is estimated to have a population of about 9 million at the moment, but over the next decade or so, it is forecast to go up by 1 million people, which if you consider how many houses that is, it's an awful lot of houses that need to be built to cater for that growing population. Now, on top of that, we've got a major undersupply of property in London. If we look at the far right-hand bar, that is the estimate of how many units need to be built and delivered each year in order to keep up with demand. And we can see over the last 10 years, in fact, we could extrapolate this back 20, 30 years, that at no one time has London been able to deliver enough properties to fulfill the supply. In fact, if we go back 10 years, it was estimated that 42,000 units needed to be built. 20 years ago, it was estimated at about 30,000. It's now estimated at 52,000 units that need to be delivered each year, and we can see that in the last 10 years, it's never been achieved. Now, when I first saw this slide, it really blew me away. It is the average price of a property in London going back to 1980. And if we look to the far bottom left-hand side, an average price of a property in London at that point in time was about £15,000. So anybody that had bought a property and who took a mortgage as well, who may put a £5,000 deposit and has held that property, will literally be laughing all the way to the bank. But we can see that the London property market is a very good, steady real estate market to invest in. The biggest blip that we see is around about that 2008-2009 mark, when it was the global financial crisis. Property prices across the UK came down roughly about 18%, but we can see rebounded pretty strongly, and in recent years has really gone up quite exceptionally well. So the average price of a property now is around about £520,000, £530,000. So again, when we look at this, sometimes we look at, some of the noise that might be going on in the media at the moment and thinking, well, maybe I shouldn't invest in a property at the moment. But when we look at a larger macro, longer term, we can see that the real estate market in London consistently performs very strongly. Now, one of the major changes that has occurred really in the last 6 to 9 months is the interest rates. As I mentioned earlier, this time last year, the base rate in the UK was 0.1%. That's the lowest in 300 years of interest rates. But we can see here, the red line is showing a 5-year fixed rate, the blue line showing a 2-year fixed rate, moving from about 2 to 2.5% this time last year, climbing up to between about 5 to 5.5%. So interest rates certainly have increased, and we know that the government is doing this partly to try and reduce and get inflation under control. It's obviously making affordability more challenging, but the long term is to try and get the inflation rates down. Now, for many people who may have only bought property in the last, let's say, 5 to 10 years, we've been blessed, all of us, with very, very low interest rates. But really, to put it into context, when we look at this graph here, and it goes back to about 1973, at its absolute peak in about 1981, interest rates were running at 17%. I remember buying property in the late 90s when interest rates were at 5, 6, 7%, and that was seen as quite normal. So I think one of the challenges at the moment is that although we're seeing interest rates rise, when we look at a much bigger window of time, that actually historically they were exceptionally low, and they're perhaps rebounding back to something that is more normal based on historic data. Now, this slide also amazed me when I first saw it. Basically, to break this down, each cluster of bars represents the black bar, a rise in property prices 1 year after an interest rate hike. The grey bar is the percentage increase of property 2 years after an interest rate hike, and the brown is after 5 years of an interest rate hike. So we've got about 10 or 11 snapshots showing over several decades that even when interest rates have increased, that it doesn't necessarily correspond to property prices reducing. In fact, in this case, we've got multiple forms of data showing that even with an interest rate hike, property prices continue to rise. So it would be an incorrect assumption to just say, okay, prices are going to decrease. This is a graph that is showing what happened to rental property in London pre-pandemic and post-pandemic. So it really is a classic V-shape. We saw that as the UK went into its first lockdown, many people thought, well, why rent in prime central London paying a premium rent when I'm no longer needing to go into the office? So a tenant can give a 1 or 2 month notice. They're more transient than people who are owner-occupiers. And many people did decide to relocate to the outskirts of London or even maybe into commuter belt towns to save them rent. But as the UK started to relax the restrictive policies, we saw a quick rebound effect and quickly seeing rentals recover to the point whereby if we extrapolate those lines, they are now actually higher than pre-pandemic rental levels. Now, this is an article from Fortune magazine that came out just last week, and again, sends a very powerful message to what's happening in the tenancy market at the moment. And if I just read the point here, tenants offering 12 months rent in advance, 50% bids above asking prices, paying demands on site, security deposits on site. So what we're just seeing is that there is such a major shortage of property that people are prepaying in advance their rents, and even when they're doing a site viewing, having funds to put down on a deposit, knowing that if they don't, within a day, that property is almost certainly going to be taken off the market. So there really is a chronic shortage. And to put this into data, this actually comes from a website called Spare Room. And the red line at the top is showing the number of hits the website is having on people looking for a room in London. The bottom line is showing the number of rooms that are available. And that's a ratio of about 1 to 7. Now, I was also reading articles from Chesterton and one or two of the other large real estate agencies where they're saying that approximately for every 20 to 30 inquiries, they only have one listing for people looking to buy property. So again, it's just showing the major undersupply of property that London is facing at the moment. And really looking into the future, this is from JLL's five-year forecast for London property growth and rental growth. If we look at prime central London, over the next 5 years, it's estimated to see an increase on average of 4% capital growth a year, and the rental at an average of 3%. If we take the Greater London, the row at the very top, that's even slightly higher, a 4.7% capital growth on average per year, and a 2.9% rental growth. So again, even though we're going through a challenging time, the fundamentals are still showing a very solid market. Okay, I think that's my last slide. I'm just trying to go through to the next one. There we go. So that's all from myself. What I'd like to do at this point is pass over to Stuart Leslie, the International Sales and Marketing Director for Barratt's Development, and he's going to take you through a little bit more about Barratt's Development and the company delivering one of the properties we will be showcasing in the next day or two. Over to you, Stuart.
Thanks, Richard. We're going to see the video now? Yep. Thanks and welcome back. So that was just a quick introduction to our Bermondsey Heights project, which we're here exclusively launching with One Global, James and his team across Singapore and Asia Pacific. It's very exciting to be back in Singapore after such a long time not being able to travel. So great to be with the team, and we've worked together for a long time, but it's really exciting to have a good lineup of events today and over the next few days working together. So looking forward to it. Thanks for having me. And hopefully we'll give you some insight into the company and also into a couple of our projects that we've got coming up as well. So for those of you who don't know, Barratt London is a brand of Barratt Developments PLC, which is a FTSE 100 company, and we are the largest developer by volume in the United Kingdom. We've delivered way over 500,000 homes to the United Kingdom market so far. We were launched in 1958, listed on the London Stock Exchange in 1968, and we continue to build 5-star Home Builder Federation customer rated properties across the capital. So our focus is really about regeneration, looking for the hotspots of the up and coming areas and how we can, as a skilled regeneration developer, add a maximum value to that area, both for people to live in and obviously for people to rent out and to commute from as well. And this year, Barratt London is celebrating 40 years. So we've been reshaping really the skyline of London for the last 40 years quite successfully. And now we're looking forward into the new regeneration sites. So a little bit about Barratt London itself. So we deliver up to 2,000 properties per year. And we have an average annual investment by Barratt London over the last 3 years of £137.4 million. So that's how much money we're spending in land and really where we see the future of the land development opportunities across London. We employ 4,830 people directly, and we have 35% of our annual properties that we sell are to buyers who are investors. So the likes of yourselves who are on the webinar today, or indeed your clients, really looking for that opportunity to buy into the London market. All of our properties are backed by a 2-year warranty and also a 10-year structural NHBC warranty. And we have rental yields upwards of 5%, as Richard was highlighting. At the moment, we're seeing huge demand for rental properties across the capital. Our prices start from £319,000, but we'll take you through a couple of projects briefly so you can understand the projects that we're offering. So the first project we'll talk about, which is really the highlight of our visit, is Bermondsey Heights. So it's a brand new project in southeast London. So it's easily commutable from the City of London. You can see in the background there, the building on the right-hand side is a CGI of how the property will look when it's completed. It's a 26-storey tower. And it consists of 165 private properties, 1, 2 and 3 bedroom properties. We are exclusively marketing these with One Global and the team. So if you have any questions about the project in detail, please jump on the phone or register your interest, or indeed come and see us over the next day or two whilst we're in Singapore. It's a really exciting area to talk about. So Bermondsey itself is really up and coming. So you can see the proximity to central London, to the City of London, and it's really an area which is primed for regeneration and for increases in values. The reason for this, obviously, its reach into London Bridge is so quick. So literally 5 minutes from South Bermondsey Station, Borough Market, Tower Bridge and the Shard, all on your doorstep. And really, that's the culture of London. No matter what happens with interest rates, or no matter what happens with the rental market or anything else, the culture of London, the education of London, and really the lifeblood of London doesn't change. London is London. So within walking distance to the River Thames as well, you can see it's the main mapscape of London, and everything has revolved around the river. But it's really exciting to even have some river views from the top floors of the building as well. It's close to Peckham, there's lots of bars and restaurants, and it's a short bus journey to Canada Water as well. So lots of shopping on your doorstep, really exciting area for people to be able to move in and out of and visit some of the surrounding up and coming areas as well. Easy access to Canary Wharf and the City of London. Of course, when you're thinking about renting the property out, the question is, where are the people going to work? And as we've seen post-pandemic, as Richard said, there's really an interest back into the centre of London. People are coming back to the office as we are here, and everybody is excited to be back out and about in the centre of London as well. And of course, as in lots of parts of London or across London, it's surrounded by lots of green spaces as well. So there's Southwark Park and Burgess Park nearby the site. So this is a great image. It highlights the regeneration that is surrounding our project. You can see in the little oval in the centre, that's going to be Bermondsey Heights when it's completed. You'll see just to the right-hand side, there is a huge regeneration area there. So it's New Bermondsey is the regeneration area. If you want to have a look or talk to the team about the regeneration plan, we have details of what's coming up in that development next to our project as well. There's 3,500 homes that will be for rent and for sale across the projects. And there'll be huge improvements to the local area. At the moment, it's light industrial use, but it's very much coming towards new streetscapes, new areas of opportunity across the borough that are going to be developed over the next 3 to 5 years. Of course, it's really important when you regenerate an area to consider things like the lighting in the area, the streetscape, the planting, making it really come to life. So we're spending a lot of time and effort making sure that those podium gardens are beautifully landscaped and that the surrounding areas are really adding as much value to the community as possible. Infrastructure is another great reason both for us to look for investment opportunities or development opportunities, but also for people to invest into areas that are going to see improved infrastructure. We've seen the effects of the Elizabeth line, and we continue to see an investment from Transport for London and from the private sector into new transport links to the borough of Bermondsey. So there's proposed overground station at Surrey Canada Road, so that will support the area's regeneration and improving connections to central London and Canary Wharf. So again, really just boosting that opportunity for rental market as well. There's a new state-of-the-art indoor sports complex for Lewisham and South London, and the scheme will provide space for digital health, childcare, sports and creative industries. There's a huge boom in technology investment in the UK as well. You'll have seen recently in the headlines, so there's the new Apple office that's opened for Europe in Nine Elms Point, or sorry, Nine Elms area. There's huge investment in technology in the Northeast Corridor as well. So we're seeing that play into these regeneration areas as well. And of course, with new regeneration comes new shops, bars, cafes, restaurants, which will create jobs and a local community as well. So just to highlight a couple of other projects that we're developing across the capital at the moment. So Hayes Village is the old Nestle factory. So it's where white chocolate was developed. It's where instant coffee was discovered, quite by accident. And it's a fantastic regeneration project, now into its third phase. It has canal-facing units and a really great example where we've developed and delivered quite a large portion of the development, which is now very successful for the rental market. We then have Springfield Place, again a regeneration project in Tooting, surrounded by huge amounts of green space and really showing some very positive signs both on capital appreciation already and also for the rental market there as well. And then we have Ridgeway Views, one of my favourite projects. So it's actually just a 20-minute commute into central London, but you can see by the picture there, you're in the Totteridge Valley, surrounded by over 46 acres of green space, and really a country estate living style, very close to commutable centre of London. So there's lots to look at across the portfolio. James and the team and Adam and the One Global team have access to all of our projects, and we exclusively market with James and the team across Singapore and Asia as well. So we're here over the next couple of days to take any questions or to help with any investment opportunities that you'd like to explore. That's a little bit of insight. I hope that we get some good questions, but giving you some information on the projects.
Thanks very much, Stuart. I think that was a very informative overview of kind of Barratt. And in fact, we're going into question and answers now, so I'm going to start with you, Stuart. Can you just give me a little bit more of a sort of understanding of what your role encompasses and how it works with the international market?
So Barratt International was set up about 6 years ago now, and we were here to service a growing market of investors from all across the globe looking to invest into London and the surrounding suburbs. And when we started, it was all central London projects, but we've now started to move out towards zones 3, 4, 5 and 6, but seen a little bit of interest back into zones 2 as well. So our job in the international team is to support our agent network across the globe and help agents support their customers to make the right decisions across our portfolio.
Okay, makes sense. James, can I ask you a couple of questions in terms of your own insight with London? What sort of trends are you seeing sort of post-COVID with the international sort of markets?
Yeah, thanks, Adam. I mean, one thing we have seen when all the borders were closed for a few years, overseas buyers, particularly at the higher end of the market, so you know, anything really over, I'd say, sort of £700-800 a square foot, was quite tricky. People wanted to go across to London, go across the UK and view properties. So since we've seen the borders start to open in Asia, particularly Singapore and Southeast Asia, since really the end of last year, we've seen that dramatically improve and buyers now coming back into London. I think Other trends that we've seen is the low levels of stock. I mean, we hadn't really seen a lot of new products in terms of new construction projects launched into the market throughout COVID. We're now seeing a lot more. Central London market, there is definitely undersupply or a low level of inventory in the market. So that's been supporting and pushing up prices. With interest rates and build costs and everything going up, that's another consideration here that we've seen. As Richard alluded to, in London, there isn't enough property built to support growing population, and that's going to be even more prevalent over the next few years with build costs and everything going up. Also, the rental market, the rental market, there just isn't enough property to rent. So that's another consideration. So from an investment perspective, that's been pushing up yields. But overall, we've seen a marked improvement in the market. There's obviously a lot going on in the world at the moment. And a lot going on in the political world in the UK, but actually with the devaluation of the pound, we've seen an increase in activity, particularly for off-plan properties. So, where you're buying into something now that's not going to be complete for 2-3 years' time, we've seen an increase in activity there, and probably a reduced level of activity in property that's coming up for completion just because of the mortgage situation at the moment. But that will invariably, stabilise hopefully in the months ahead.
On that same note, James, what are you seeing in terms of the kind of purchase? Are we looking at mainly investors now, or are we still looking at people looking for secondary homes?
No, I think we're seeing both, definitely. We're definitely seeing a lot of newer, younger investors coming through the market, which is great to see. But now, again, when all the borders were shut, there was obviously a lot less. One trend that we do see is people buying for their kids who are studying in the UK, and that was very reduced during COVID. But we've definitely seen an increase there. So I think people buying for second homes, definitely second homes at the higher end of the market, the luxury end. We've seen a lot more activity in that space, but there is just a low level of inventory at the moment.
Richard, I'd like to come to you for a second. Obviously, being on the front line in terms of sales brokerage, what would your advice be when it comes to sort of deciding on where to invest in London, and what sort of factors would you be looking at?
Sure. I always like to talk about pockets of value and where we can see areas that hopefully will outperform the average. Otherwise, why come to One Global and seek our advice? And I often use this acronym that I refer to as PI. So P stands for population growth, I stands for infrastructure, and E stands for employment. We've touched on the importance of regeneration infrastructure, and one pocket of value is looking for areas where we see major master plan and regeneration, really because you're able to get in at an early stage of the area being redeveloped, typically getting at attractive prices. And as that regeneration master plan is delivered, then there tends to be a disproportionate increase in both capital and rental growth. Now, within a major regeneration area, office space may be built. That's going to create employment. Where we see employment, typically we're going to have people that want to live or work relatively close to that, so we see a population growth. So I think really, one key thing is to look at areas of major regeneration and how that, what I call this pie effect, can disproportionately increase the value.
Okay, that's sound advice, I think. Stuart, can you just give me, in a sort of succinct way, what sets Barratt apart from other house builders and developers in the UK?
Sure. So if we look at the historical values of Barratt Homes, really it's centred around good quality affordable houses for families to live in. So the premise of the way that the company started was that Mr. Barratt in 1958 couldn't afford to buy his own family home, so he clubbed together with some friends, bought some land, they built more properties than they needed, and so they sold off the excess and were then able to afford their first family home. And although we've grown into the UK's largest home builder now, those values still remain true across the company. So we're building properties in areas that we believe will be great communities. We try to create as much community added value as possible. As Richard said, we always look for these opportunities of areas of growth. But really, we have smiles on our faces when families move into our properties, live there and create good memories.
Makes sense. Staying with you, Stuart, just a little bit, we've touched on Bermondsey Heights there, with a brief overview, but why, in that same vein, is Bermondsey Heights such an early, interesting opportunity for overseas investors?
Well, I'm really excited about the project because, first and foremost, as James alluded to, there's not a lot of stock available in the market. This is, in fact, the first project that we've brought to market new by Barratt London for the last 3 years.
Yeah.
So it really has taken a great deal of time and effort to find the opportunity to bring a new project to a new area. It's also very early in the stages of regeneration as well for the area. Although we have confirmed the infrastructure improvements, we have confirmed the regeneration projects next door to our site, we will be delivering the project in 2024, 2025. So at the end, it will be very, very quick to come to market. Yeah. And that will be really the opportunity for rental tenants to come in and secure those properties ahead of the other projects coming into fruition.
Is it fair to say also, because Bermondsey is not just developer-led, it's also led by the council and de facto government? So that gives an infrastructure, that gives the growth real credence.
Yeah, I mean, there's so many factors that if you look at the schools in the area, they're all being heavily invested into. The community facilities, there's the old biscuit factory, which is co-working spaces. You have super leisure facilities around the project as well. You've got climbing walls and all sorts of exciting things going on. But really, the opportunity is the long-term growth for both capital and the rental market as well. And that proximity being in Zone 2 is really exciting. So it's the first Zone 2 project that we've had for a long time. And it's also very exciting to have something that's so close to the City of London as well, and Canary Wharf. So it's really going to service those young professionals and people that are looking to get their footstep on the ladder.
Richard, I'm going to ask you a bit of a loaded question. But based on the increasing interest rates, and obviously you touched on that on your slides, should I buy now as a Singaporean with the exchange rate to the Singapore dollars being very favourable, or should I wait and see based on other factors?
Yeah, I think it's a very common question that is being asked, and certainly speaking to a lot of investors, they do have genuine concerns because of some of the sort of political turmoils and economic situation at the moment. I can't really say that one size fits all here. I think you have to look at each investor and it really depends on a certain situation. What I can say is that there is always opportunity though when there is uncertainty. And when we look at one of the opportunities, that being the exchange rate being so incredibly good for people earning Sing dollars, there is one strategy that can be, well, let me take some of my Sing dollars, put a deposit down on an off-plan property so I get the benefit of that exchange rate now, but wait for maybe 1 or 2 years before actually completing on that property, with the hope, not the assumption, but with the hope that interest rates may moderate when it comes to securing a mortgage. I have other investors that might be in a position to buy in cash. And again, taking advantage of the incredibly good exchange rate, buying the property in cash, and then waiting to see next year or the year after, and potentially then refinancing. I think, for other investors who really are very, very cautious and really want to take a wait and see approach, but if they are definitely committed to buying a property at some stage in the UK, but just not quite sure whether it is the right time for them now, one other option might be to look at maybe buying a bit of pound sterling, taking advantage of the exchange rate. So they've got that ready to go when they feel the time is right for them to invest.
I think just from a developer perspective as well, it's really important to show the confidence in our land pipeline as well. So bringing a new project to market, we're really excited that this is the right time to launch Bermondsey Heights. But also we're investing heavily into the next projects that we're going to be bringing to the market over the next 2 or 3 years. And that really is driven by this fundamental undersupply of property in London. And I would say, question as to whether you should buy now or later. There's lots of different ways to win a game of Monopoly. You can buy lots of different types of property, but if you're not playing, you're definitely not going to win. And I think, Richard, you're absolutely right at the moment, whether you hedge a little bit of currency or you indeed sign up to an off-plan property, the exposure and the opportunity at the moment is probably more than it has been in the last 5 to 10 years.
And actually, just to add to that, I was actually emailing a client earlier today saying, well, if you just sit on your cash at the moment, knowing that inflation here in Singapore, I believe, is running at about 5%, and the UK, I think, is close to 10%, this time next year, your money will have eroded away. If you are taking the position, well, let me get my money working for me, we're looking at up to 5% yields on those properties in London at the moment, and getting that cash working for you as well. So, there is a great window of opportunity still. And when we, again, look at the macro picture here, if you remember the slide I showed from property prices going back to 1980, roughly speaking, property prices in London, have been doubling every 8 to 10 years. So if we could all time the market at the exactly lowest time in terms of property prices or interest rates, we would all be billionaires and we wouldn't be sitting around here probably. Yeah. But as you say, Stuart, being in the market and being in the market for a medium to long term has consistently shown very, very good results.
Couldn't agree more. James, I'm going to come to you finally. Obviously, you've been in this market for a long time. What sort of advice would you give to a first-time investor looking to buy their first investment property? Is there one piece of advice you'd like to share?
I think that these guys have given some good advice as well, but I think if you're buying an off-plan property, developer, and I'm not just saying this because our clients from Barrett are here, but going with a very good quality developer, if you're buying off-plan, is probably more important than it has been in a long time, for the reasons that we've talked about: interest rates going up, build costs going up, and all those sorts of things. So I think really doing due diligence on that side yourself and going with a reputable developer that that's going to deliver a good quality product and is financially sound is very, very important. And we just talked about it, whether you're buying off plan or looking for completed property now that you can make your money work. I think the cash flow side of things, if you're buying off plan, is really important. So none of us can guarantee where interest rates are going or where they'll be in a few years' time, but being a bit more conservative in terms of your cash flow projections and what rent you might get and where interest rates might be when you get a mortgage is an important consideration. So hopefully that's good bit of advice.
Very sound. Well, look, I'd like to thank you all on the panel for your time today. And hopefully it's been very informative. If you have any further questions, please do get in contact. One Global Group. Our team are here to help you. Barrett are in town, so please do get in contact if you'd like specific information. And until the next time, thank you very much.
Thank you very much, guys.
Bye.